illustrious exit. My name is David. Most of you have know me. We have met before, obviously. One of the organizers of this academy. So today we're joined by a wonderful panel of experts, which also means that I'm going to leave the talking very much to the experts. This is a short agenda for today, right? So we're going to have a panel discussion, we'll have an open Q&A, and then we'll close the session. But I very much hope that we're going to make the whole session very interactive. So any questions, any comments, any words of wisdom you want to share, just drop them in the chat, and we'll try to bring them into the conversation. Where possible, I'll ask you to unmute and ask the question, or I can ask the question myself, of course. So this is obviously one session which is part of a series of masterclasses and Q&A that are part of the current cohort of the African Angel Academy, the cohort that we're running in partnership with the UK International Tech Hubs. And then for the panel members, so for Tarek and Chinedu, Andrea. So today you are joined by a group of both aspiring and existing investors that come from Kenya, South Africa, Nigeria, or investors that are residing in the UK but are interested in investing on the continent. That's probably a good moment for me to introduce our panel members for today. If you could take me to the next slide, Ayanda. That's me, of course, but it's much less interesting than our panel members. Thanks. So we're being joined today by three absolute experts, three people that are sort of very visible in the investor community. So if I guess maybe I can say a few words about our panel, then I'll let them introduce themselves in more detail. But Andrea is with Knife Capital. If you would ask me to name the most sort of relevant early-stage investors that I would definitely include in my list, Knife Capital, very active as an investor, also very active in the ecosystem, very, in a way, very, I think, professional in their approach, but also still very sort of human and humble in how they go about this, how they interact with investors and entrepreneurs in the ecosystem at large. So I'm very happy that we have Andrea with us today. Second is Tarek Kady, someone that I also very much admire. I've known Tarek for a couple of years. He is the mastermind behind an angel network in Alexandria, Egypt, called the Alex Angels. He's been able to set up a network only a few years ago, but then also started investing very quickly, but also started doing syndicated deals within the network, but also started doing syndicated deals across or amongst different networks in Egypt. So the Alex Angels in partnership with the Cairo Angels, with the other angel networks. So being able to do syndicated investments in a very short time. Tarek is also behind an initiative called the Med Angels, which is bringing together angel networks from a number of different countries around the Mediterranean, which of course poses a whole set of new questions about sort of, co-investments and legalities and the flow of money, and how do you build trust together? So how do you effectively do investments across borders amongst networks? And then Tarek does many more things. He also runs one of the largest events on the continent called Techni Summit, which is possibly not as well known below the Sahara, but in North Africa it is. It's probably the biggest event that we have. I'm going to say 10,000 plus people, but Tarek can correct me or elaborate maybe a little bit on that. And then last of our speakers is Chinedu Enekwe. So Chinedu is, in my view of the world, one of the originals. When I sort of became involved, maybe some 10 years ago, Chinedu was one of the people that was already, running incubators and accelerators and early stage investment funds, angel networks. And one of the reasons why I thought it was interesting to bring Chinedu on board for this conversation is that he's always had this sort of diaspora angle, because he's been dividing his time between the US and the continent and Nigeria. So Chinedu has been very much sort of done a lot of sort of critical thinking around how do you mobilize diaspora investors, how do you allow people to get involved, how do you do deals, how do you get deals done across borders, which I thought was, of course, particularly relevant for this group, because we have a group of diaspora investors that are part of this program. So they're obviously residing in the UK, where Chinedu's background is in the US, but I think that there's obviously many similarities. So like I said, I hope this is going to be a very interactive session. Any questions, just drop them in the chat. Also, other than questions, if you have comments, if you want to share wisdom, etc., just drop them in the chat and we'll try to bring them into the conversation. And then I'll ask the panel members just to elaborate yourself, and maybe as you introduce yourself, and as you go about introducing yourself, maybe there's also one question that you can kind of speak about is how did you become an investor? How did you become involved in this world, and what made you become an investor? So with that, I'd like to invite Andrea to say a few words and introduce yourself. Please, thanks.
Sure, thanks, David. Yeah, so my name is Andrea Bohmert. As you can hear from my accent, I'm actually not South African. I'm originally from Germany. Came to South Africa in 1994 as part of an internship. So I'm always very, whenever people apply for an internship, I always kind of say, be very, very careful. You might think you come for 3 months and then you stay for the next 25, 26 years. It's a dangerous thing. So I've been in venture capital for the last 14 years. Well, and to be honest, if you would have asked me 20 years ago, what is venture capital, I definitely wouldn't have even known what it really is. So it's definitely not something that I had planned. I came to South Africa straight from university, and then we did a corporate career. And actually, I enjoyed my corporate life. I kind of thought I was a born corporate animal to some extent. But then, yeah, found out how important corporate culture is for me, or company culture is for me. So after working for companies that I really enjoyed working for and with, I ended up with a company where at the end I kind of thought, no, this is not me, and I left and started my own business, and started working with young IT entrepreneurs, because what I had seen is there were so many great entrepreneurs out there. They were fantastic from a technical point of view, but they really weren't that great commercially. So I kind of thought, let me, together with some partners, start a company to go and yeah, help those companies. I knew the commercial side, they knew the technical side, and I thought that was great. Naturally, they wouldn't be able to kind of go and pay me my typical corporate salary, so I started getting tiny pieces of equity in a lot of kind of startups, and to be honest, didn't make much out of that. So, but it was a very interesting experience. However, after about 2 years, we had a number of companies that actually were fantastic and great, but needed venture capital. And we're now talking about 2007. In 2007 in South Africa, you know what, there were 2, maybe 3 funds, but definitely there was hardly any venture capital available. And I think very naively at that point of time, I kind of thought, well, then let me start a VC fund. So I kind of went to the banks, financial institutions, and said to everybody, you know, please go, you all know it's needed, please go and give me some money for a VC fund. And I have to say they all met with me, which is great. They didn't laugh in my face, which is also great, but in principle all told me absolutely not. Venture capital in South Africa cannot work into tech companies, absolutely not. Only works in Silicon Valley, just forget it. No, sorry. And it's not going to move the needle, so definitely not going to go and do this. So part of this, then I was quite frustrated and decided, well, in South Africa, nobody wants to go and give me money, then maybe I have to go and look outside. Coming from Germany, I kind of thought, well, then let me start in Germany. And for me, the big thing was to kind of go and convince someone to invest in Africa or to invest in South Africa. You know, you either believe in it or not. So I was looking for people who believe in South Africa, who have enough money and who buy into venture capital. And I did a bit of research and came up with 2 names. And one of the names was Hasso Plattner, who was the founder of SAP, the big kind of software giant. And I knew that he was one of, at that point of time, I think was 110 richest men in the world. So he had money. I knew that he owned Fencourt, which is a gold estate in South Africa. So I knew he loved South Africa, and he had just started a VC fund in Berlin. So I very naively kind of go and went in and looked into LinkedIn, and I saw if you want to contact somebody at SAP, it is firstname.surname@sap.com. So one Sunday I kind of sat there and I wrote an email to Hasso Plattner and said, this is who I am, and I know that you love South Africa, and don't you want to go and help me start up a VC fund? And he gave me 25 million euro, and that's how I kind of go and got into venture capital. This is really just, this is how I kind of go and got in there. I have tried those emails over and over again, and it has never ever worked again that much. So I have to say, I can't say that this is a formula that's scalable, unfortunately. But yeah, this is how I got into venture capital. This is how I started Hasso Plattner Ventures Africa in 2008. In 2011, I joined Knife Capital, where I'm one of the kind of co-managing partners. We invest in what we call Series A kind of technology companies. So it's companies who have some kind of traction, have a beachhead market in Africa and South Africa, and now really want to go broader, want to either go into the rest of Africa or kind of internationally. The companies, of course, are not profitable, they are burning, but they have some product market fit and really a plan to kind of go and take this further. We normally invest between, let's say, in terms of dollars, let's say $500,000 to about $2.5 million. That's normally kind of our range, and we take significant minority stakes, which means normally around between 15 and 25% equity. That's what we do.
How many investments has Knife Capital made over the years?
Well, the first fund had 7 investments. Our second fund now is number 8, and we are going to announce number 9 in the next few weeks. Then I've personally done a few angel investments, and yeah, so I think that's kind of that's the number of investments.
Okay, and then the focus area is South Africa, but you've also ventured outside South Africa already?
So the problem is that with both funds, so A with Hasso Plattner, and if we add Hasso Plattner, then I made 8 kind of investment in Hasso Plattner at that point of time. So with both funds, unfortunately, our investment mandate has always been, it had to be South African registered companies. I mean, it was always quite tough because, I mean, we saw some amazing opportunities in companies outside of South Africa, but our mandate never allowed us to kind of go and do this. We are busy raising a next fund, what we call a Series B fund, to kind of go and augment our, let's say, our value chain of starting with very early stage companies through our accelerator, then doing the Series A, and then later on doing Series B. And this one, we definitely want to be able to kind of go and be able to invest wider into Africa, as long as there's an African kind of core component.
Okay, wonderful, wonderful. So thanks again for joining us. Thanks again. I know you're super busy, so I really appreciate it. Maybe it's good to move to Tarek, and then from there we'll go to Chinedu. But Tarek, you wanna say some words about yourself?
Yeah, sure, David. Thanks a lot for having me. It's always a pleasure to be connected. Hopefully, face to face again soon. So how I got into investing. So we started 5 years ago this tech event in Alexandria, Egypt. We were trying to connect startups with investors and corporates and the rest of the ecosystem. And then from a small event that had around 900 people, our last event had 13,000. We realized 2 years down the road that there are a lot of opportunities that we're missing out on investing ourselves. So I started the Alexandria Business Angel Network. We had 6 core members, and we realized that having an angel network that is present all year round in Alexandria, with the startups over there, we can help them achieve their goals and help them out, but also have some shares in their companies. And around 3 years, we attracted more than 45 investors in our angel group from 5 different countries, and we're focused on investing in early stage startups in Egypt, not outside of Egypt, with the Alex Angels. We have around 23 companies in our portfolio, and we realized the challenge with angel networks is the lack of availability of the angels, the lack of the cash is not available all the time. So we realized that syndicating deals with the rest of the angel network saves a lot of time on diligence, and also allows the networks to have more investments done collectively. So we created a syndicate with all the angel networks, AUC Angels, Cairo Angels, and Him Angel, and we have at least around maybe 7 or 8 deals that were closed in that syndicate, and we're continuing to do that. And realizing the gap in seed funding in that stage in Egypt, but also in other emerging countries around the Mediterranean. So we thought that it's a good idea to start the Mediterranean Angel Network, which is a network of networks that operates to facilitate and circulate deals for the ultimate purpose of promoting cross-border investment through syndication. That's the whole story about angel investing. But again, we're also closing an angel fund, a seed fund, so that we can have more deals invested by co-invested by the fund with other angel networks, because this is the problems and the issues with angel networks. Everything has its pros and cons, but one of the things that can actually expedite having deals closed quickly and incentivize the rest of the networks is to have a fund. So it's a small fund. It's an $8 million fund, and its purpose is to invest in 50 companies within 3 years. So hopefully getting that closed within first close this month.
Very good. And maybe just a few words about where you are right now.
Where I am right now. Okay, so we have something else called the Techni Drifts aside from the summit. The summit runs in Alexandria and runs in Bohmert, Croatia, but also there's the drifts which goes around Egypt. So we instead of hopping one city after the other, we just charter a big Nile cruise, and this would be the venue. We'd stop at each city and have all the entrepreneurs hop in on the deck. This is the stage. The speakers are on board. We do a pitch event. The winners stay on board. We have a boot camp and then do a final closing in Aswan. So if you guys are interested, then we're doing next year from Cairo to Cape Town. A little bit of boat and a little bit of bus, and we'll have fun along the way.
I think that a lot of people on this call will find that extremely interesting. I would find that very interesting for sure. But just to comment on your story, I've been sort of working with a lot of angel networks over the past so many years in my work for the Africa Business Angel Network, and I think it's really admirable that you've been able to launch a network, get deals going, syndicate deals with other networks, set up an angel fund, all sort of in addition to the other work that you're doing. It's really admirable, and it's I think that to some extent it's really an inspiration for many other networks who are sort of trying to find their way and find their module and trying to see how this works. So very happy that you're joining us today. And also for the people in the audience, I mean, obviously this call is too short to answer any questions, but I trust that Tarek is available also for follow-up conversation if there are specific questions that Tarek could help with. Besides the fact we're all going to meet, of course, next year on that boat of yours and have some fun. Very good.
Looking forward to that.
Okay, so of course always someone has to be last in line. Sorry, Chinedu, but I guess it's you today. So just maybe a few words about your background, your involvement, also about your story about how did you become involved as an investor.
Okay, perfect. So what's interesting is how this all got started for me. I was an investment banker at this firm called Dinosaur Securities, which did pretty much trading of African or basically exotic debt instruments, and African governments at the time, especially even still now, kind of represent that. So I was their head of Africa coverage. So I was flying around managing the brokerage relationships, and then also managing the relationships where we had some advisory practices, some advisory or investment banking. So what I realized along the way was there was an opportunity for me to launch my own kind of technology business. I launched it, scaled it, and it was like a fintech business that focused on stock brokerage businesses and helping them build a mobile application. And I did that at night. And, I leveraged the relationships that I had with investment banking across the brokerages that I was maintaining those relationships. And I sold that business to the company I was working at. And I realized at that time that there was a whole bunch of people like me, right? Like a Nigerian that relocates back. And it was, a lot of companies at the time in 2010 that were being started and funded in the same way, that they were people that had spent some time abroad. And then they raised a little capital, came to the continent, and they were, it was Jason Njoku, it was Tayo from Paga. And I said to myself, when I moved back to the States, I said, why don't I just invest in people that were just like me, that are, whether they were recently out of school or, professionals that had an idea in technology. If I did it, I thought the fix was in, right? Because I had a proximate relationship to them. I could see them first, and then they would go raise more capital, and I would, make out. But at the time I was telling people this, I came back to the States. I was working for Obama at OPIC, managing the Power Africa initiative. And I was saying that there's this big opportunity in African tech. And it was like I was hitting my head against the wall, similar to how Andrea was saying that she was going around trying to tell people. So it took me about a year to figure out how I would approach it. But I started off with an accelerator called Tip Hub Africa. And I said, I was trying to do angel investing. We worked with several companies. We did events at the World Bank. We ran this virtual accelerator program, brought people to the United States for 2 weeks. And we did this about 3 times over the course of, I guess, 4 or 5 years. And at first I was working for the government, so I couldn't personally invest. So then I left the government because I said, this doesn't make sense. I worked for the World Bank at that point, and I was investing. And I said, this still doesn't make sense. I'm still preoccupied in terms of my work. And I said, let me just get into venture 100%. And that's when I started my syndicate. I mean, I was already angel investing, but I started my syndicate, and that's called Affinity VC. And at first, I was trying to inspire confidence with the syndicate and the investors, because some of the people had already invested in me, but most of the investors were like, how I describe it, basically government contractors or Black technologists. So they were interested in Africa, and they had money because of the government contract businesses that they were running. But I still had to convince them that, that even just the asset class was valuable. So my thought was strategically to get them into later stage investments, and then get them into, get their risk profile dotted around venture at the different spaces and capacities. So we did that in a couple of investments, and I decided I was working at a venture firm called Exponential Creativity Ventures, and we were invested in tools for, tools for creatives, but I was making sure that I was investing in immigrants. And I said to myself at a point, I met my partner, Mark Fleming, who was working at Alibaba, and he says, Chinedu, there's so much going on. You're the person to invest in Africa. He was working at Alibaba. He said, I'm the person to invest in, Southeast Asia. Why don't we go around and convince people that we can invest in the immigrants in the United States that are going to launch their businesses in these new markets? So that's when we launched our fund called O21 Capital, investing at the seed stage. It's a $50 million fund. But all of this has just been like this round robin circle to really kind of identify with myself. And I think a lot of times when you like the angel investing, when I initially started Tip Hub Africa, we started doing these dinners called the Diaspora Angel Dinners. And it was funny because no one was showing up. There was like 5 people every time. But now, you know, we have all of these groups that there's, you know, I did these dinners in New York, in DC, in Philadelphia, in San Francisco. 5, maybe 7, 8 people would show up, and this was free dinner. It was, you know, everything was free. I was sponsoring it myself, and no one was showing up to free, right? And I was confused. But now we're at the place where, you know, I'll randomly get a message from a group of 30 people who are angel investors in the diaspora, and whether it be in London or in the US somewhere. And I'm so surprised now that it's like, it's the self-organizing thing where it doesn't require, like, people are just interested. It's like top of mind. People are recognizing the trend. So I'm happy to be here to have this discussion with everyone.
Great, thanks. Thank you so much for joining. So I guess that one interesting observation is that I guess none of you or everyone sort of became an investor. It came on your way, sort of. No one sort of, I guess, you know, figured out from school on that he, you know, wanted to become run a VC fund or so. But that it's, you know, you kind of all sort of found your way in becoming investors. So thanks again for the introduction. Like I said in the opening comments, so this masterclass or this session is part of a series of events. We've done a session on valuations. I think next week we have negotiations coming up, and then the theme for this particular event is exits. And of course, that's a topic that always comes up because it is critically important for investors, for entrepreneurs, for the ecosystem at large. For exits to happen, and we can take this discussion in many different ways. But maybe a question for you, Tarek, and I didn't prepare you for this, but maybe if you can say a few words about the story of Karim in Egypt, in the Middle East, and why you know what happened with that exit, and why that is important. What is happening now within the ecosystem if such a sizable exit takes place? And maybe, and again, I didn't prepare you for this. Maybe you could sort of take us back 2 steps and speak about what is Karim and how much money was involved with this. I trust you can.
Yeah.
Okay, thanks.
Sure, of course. So this was, you know, your question is very interesting, because when I started the Angel Network, everyone was asking, where are the exits? I mean, how much money did you make? And I couldn't convince them to join. It was very hard because we didn't do any exits, and we were just starting. But not just us. No other angel network or the whole region had any exits. I mean, very few. But then when Karim came, I mean, there were exits, of course, before, but not in Egypt and not big, but not with angels. And then Karim is a ride-sharing application, just like Uber, but you know, customized for Middle Eastern riders, let's say, and drivers. And it was acquired by Uber for 3.1 billion, or maybe 3 years ago or so. And that was a huge exit, and the returns. I mean, there were some angels on board, and the share was, I think, whoever had 1% had $31 million, and that 1% 8 years ago was worth $100,000. So that was, you know, one hell of an exit for a lot of people. And prior to that, there was the Souk and Amazon exit also. Was less than that. It was supposed to be a unicorn, but the actual exit ended up for like any 500, 600 million. But I mean, this was something that, you know, had people trust what's happening, and that there is cash and there is an ROI. There are some things to consider, until we also you know, started having our own strategy for exiting, which is partial exits. I'm not sure if, you know, I can talk about that now or maybe later on, but we've done a couple of those. Haven't announced them yet, but the last one was closed a couple of months ago. So we're pro partially exiting for 2 reasons. One is that we're getting our capital back again to reinvest in startups, other startups, but also not to scare other people who are coming in and follow-on funding. So we're still there. We're selling, let's say, 1/3 of our shares, getting back our capital. So our last exit was, it had between 3 to 4x, depending on the prior investments, had the investors invested in one round or two, but we got most of our capital. Not most. We had actually the prime investors got who went into 2 rounds, got all their capital back, and they still have 2/3 of their shares in the company. And other people had like more than 1.5 a surplus on their return. So that was a cool thing to do, and we actually incorporated that in all our term sheets and shareholder agreement that we can sell part of our shares.
Okay, very good. Just to go back, and I'd love to explore this further, right? That the partial exits and both what it means for investors and also maybe for the entrepreneurs. But just to go back to the Kareem story for a second, because I think that these kind of events are important, not because people necessarily become rich, but also because you know, there's capital flowing back into the ecosystem. And sorry, I have my youngest son who's decided to join the festivities. Come, yes, Ali. So there we go. So
future angel investor.
Yes, the future. But what I was trying to say is that right now there's capital flowing back into the ecosystem. You have let's see how long he's gonna sit quietly here. But so there's money flowing back to the ecosystem, which means that there's the follow-up effect always seems to be that there's many more startups that follow, because now we have. You know, we have angel investors that are successful. They want to reinvest their capital. We have founders that are, you know, that have come into money. They usually want to start new companies. So the trigger down effect of such exits is critically important for the ecosystem. So the fact that Egypt now has seen a few, I think that has, besides it being sort of an inspiration for entrepreneurs and an inspiration for investors as well, it simply it lifts up the whole sort of ecosystem. I mean, I think that's one of the reasons why Egypt maybe is a steps ahead of some of the other countries in the region. But maybe it's maybe we can part the conversation on the partial exits and then turn to Andrea for a second. Obviously, South Africa is also, every ecosystem has its own sort of dynamics, its pros and cons, etc. South Africa is obviously a more mature market than some of the other African countries, has seen a fair share of exits, maybe not at the size of Kareem and Souk, but definitely, of course, is a mature market. So a very practical question for you as an investor in terms of how do you work towards exiting? How do you as an investor, you know, how much is that part of your agenda, you know, already when you invest into companies? How do you go about sort of, you know, working with your portfolio companies, preparing them for exits, etc.? How much of your day-to-day work is around exits?
Do you want the truth or the marketing pitch? No, but
nothing but the truth. We're no.
No, so. Sure, absolutely. So when we go and do a motivation for investment to our investment committee, the 3 last slides, no, but part of the last 10 slides, let's put it like this. There are at least 2-3 slides that are aimed at the exit universe, aimed at exiting. So when we invest with the exit in mind. Actually, our 4-word kind of summary of what is enough capital is what we do exit-centric business building. It's all about building businesses with the exit in mind. And why this is quite important is because you need to kind of really go and understand from the day that you are investing, because remember, it's not our own money, which of course is a big difference to angel money. I mean, we have a mandate to kind of go and somebody gives us money and it's our job to kind of go and deploy that money and provide a return. So when we invest, when we deploy this money, we need to go and really think about how are we going to go and get the returns back. And therefore, we need to understand, who would potentially kind of go and buy the business? Because I have to admit, we don't really kind of go and put IPO into this kind of exit plan. Not that I don't want to do an IPO, but I think it's going to be more likely that we're going to go and have a trade sale. So who would kind of go and would go and buy the business? And more importantly, what would they buy the business for? Now, if we kind of go and look at the exits that we've had, I mean, if you think about a Fundamo that was bought by Visa, I mean, it was nice, it was a $110 million exit, it was fantastic, but it's very, very clear. Fundamo was never, ever profitable, not 1 month in its whole life. So they didn't buy it for profit. To be honest, they didn't buy it for revenue. They bought it for their access to financial institutions in Africa, so access to market and for IP and for team. And so with all of our kind of, we need to understand who is this company? What is really their kind of, let's say, core attractiveness to somebody else? What is the core competence? And what would somebody kind of go and buy? And this is what we have to go and strengthen. If we know that we have a company that's fantastic, has fantastic IP, we need to understand that A, this IP has to be fantastically protected, and we need to go and continuously go and strengthen. If it is for access to market, if it is for the brand, if it is for their supply chain relationships, if it is whatever it is, we need to understand it, because our whole post-investment strategy has to be aimed towards strengthening those kind of things. And do things change over time? Absolutely. That's why once a year, when we have our strategy session with our portfolio companies, we sit there and we revisit. Do those assumptions around exits? What has changed in the market? Does it still kind of go and apply? And sure, sometimes things might actually kind of go and change. But we think about the exit from day one, and every big strategic decision that we make, one of the questions that we go ask is, will it move the needle? Will it kind of go and support our exit strategy? And if not, why bother doing it? So now, absolutely, it is definitely something that we plan for from day one, and that we follow throughout this whole kind of post-investment kind of long journey. It really is about how do we get the returns, and how do we kind of go and get to an exit also that is mutually beneficial. It's not about we as the investors go and get a fantastic deal, and you as the entrepreneur, you don't. So how do we, and that's why we have to go and work together and walk this journey together towards a great exit.
No, I think you raise a number of very important points. So I guess that it's very good to just sort of, restate that the majority of the exits by far on the African continent will be trade sales, right? I think it's maybe beginning aspiring investors have IPOs in mind, but that is simply not how the world works. The world works today. So, and then the other, of course, very important point is that, why do people buy companies? And then, so like you say, it is not necessarily, or maybe not at all, about profits, right? It is about IP, it is about market share, it's about, there's multiple reasons why trade sales happen. And so I guess your last comment was about making sure that you are aligned with the entrepreneur, which of course is a question that kind of comes up in terms of how do you make sure that your agenda and your thinking about exits and the thinking of the entrepreneur are aligned. Because I could imagine that some entrepreneurs are, maybe not ready to exit, or have other plans in mind, or do want to, build the company out to IPO level, etc. So how does that function? Is there conflict sometimes, or is that a conversation, or how does that work?
It is a conversation, but it's a continuous conversation. And I think one thing we need to understand as investors is that the entrepreneur that you invest in on day one is a different one than we have 5 years later. We all change. Our life circumstances change. It all changes. So whatever maybe the entrepreneur promised or really, really wanted 5 years ago might be different now. And that's why it is a continuous kind of conversation. And for example, we had one portfolio company where we got an offer from a third party, a very attractive offer. So we, of course, wanted to kind of go and exit. And the entrepreneurs then came to us and said, we are not ready to exit. We don't want to. We believe that there's still more to go. So we don't feel comfortable. And then what we did is we kind of said, okay, fine. So the valuation has been set. We are going to go and help you raise enough money so that you can buy us out. And you can then go and continue the journey, which of course took like 9 months longer. But what it did is it made sure that everybody was aligned, that everybody was happy. That because let's just be very, very clear. We can have the most amazing protections in our agreements. We can have all of it. I mean, if an entrepreneur does not want to kind of go and exit, they can jinx every exit. I mean, it's this little kind of sentence while you are in the discussion with the potential acquirer who says, yeah, of course our IP is good. Well, there are little snacks in the technology, but, or you kind of go and, you know what, it has to be a win. It has to kind of work for both. If it becomes hostile, it becomes a totally different kind of story. So I think it is that's why it's also very important that we really understand what the entrepreneurs, what is it that they're looking for, what is their time frame, and how we can somehow kind of go and accommodate them. Because again, an exit does not have to mean a full exit of the company. It could just mean us exiting as an investor. And then if so, how can we potentially facilitate this? So I think there's many ways to kind of go and do this. But you know, this is a long-term game. It's also a long-term game in the ecosystem. I mean, if you go and, excuse my language, kind of screw an entrepreneur, others will find out about it. So at the end, it is really about trying to make sure that each one of those deals at the end becomes a win-win. And everybody is proud to kind of go and talk about the story. And it's not just a one-sided little success story.
You know, I think there's an element that's interesting from an angel perspective, that you, as an angel, you can make investments, and oftentimes you're like the first investor that has given them confidence, given that founder confidence, and sort of putting them in the world of startups, right? So you get the opportunity to be seen as an advisor, as a friend, as a true believer. And, you know, in terms of exits, what happens, just like Andrea said, is that, you know, from this entrepreneur journey, from what I've seen, is, you know, if you're an angel, you're there where, you know, everyone has their eyes all bright and happy. And then 5-6 years later, they're a total different animal. You know, if they have a beard, it's not shaven, you know, they're a little bit messy. And what I've learned is, you know, just kind of, you know, it's not a gratuitous thing when you invest, right? It's a business thing, but oftentimes you build this relationship and you get to know the founder and know where they are in their lives, right? And, you know, often there's a marriage, there's a kid, and all of these things. And these life circumstances, to what I've seen, are what drive more of the exits that I've seen, right? And it's like, I'm just tired, right? I'm looking for this opportunity. And what I've learned is what I can do is set up partnerships or sort of business relationships that along the way of that founder's life, and continue to maintain a relationship with that partner that I introduced, to know what they see or perceive as value in the relationship that they have with the startup, and ultimately selling them on the idea of a potential acquisition, right? I'm always kind of, you know, whether I sit down for drinks or having an email and say, you know, have you guys thought about just, you know, doing something where you acquire them? And so, for instance, in one situation with a startup that I worked with at Tip Hub Africa, Bionic, and last year they had an acquisition, but I had totally forgotten that they were essentially one of the companies that I've worked with or invested in. It's, you know, $5,000 in 2014. What am I even thinking about? So, but, you know, when it came down to the time, every time that they would come to the States from Uganda, they would talk to me. They were asking me about questions about, you know, just general catching up, but friendship. And then when the opportunity came for an offer on the table, they were asking me about the strategic value of that opportunity, right? And it led to the exit. But for me, what was valuable is the relationship and the kind of clear, open lines of communication that allowed me to help them set up with partners, and then also advise them when came time to decide on their exit. I'm sure my advice wasn't the only ones that they got, but it was good to be a part of that discussion.
Very good, thank you. So I guess that one more question that comes up to my mind from this conversation is that also what Andrea said about, you know, as a VC fund, you have a responsibility, you're managing other people's money, possibly your fund is time definite. So, you know, that exit is very much, you know, that's part of your work, if you will. And then I guess the question that comes up, if, you know, as an angel investor, this being your own money, does that then mean it is more patient capital? So you have less of a mindset to work towards an exit, or is that simply not true? Are you as much focused on doing deals and your next deal, etc.? Is there a difference in how angel investors investing their own money and VC funds managing other people's money, how they approach the exit? I don't know who's maybe best suited to answer the question. I don't know if Tarek or Chinedu, if you have any comments here.
Definitely, from when I put on the hat as a VC and as when I had my angel investor hat on, which I still wear, I think the challenge is when you're investing with a purpose, that's what determines it. Like VCs, you already have a purpose. You're investing for other people. You have to have a return, or you have to structure a return. As an angel, there's so many different motivations for investing. One of them can be establishing a track record, so you become a VC. Another is, in which you might be more attuned to like a venture capital firm mindset or investor mindset. Or if you really are just focused on getting returns, the way you might structure your agreements of how you have the opportunity to sell down your position without first right of refusal, or with, a predetermined bump in terms of the sale that would happen. So I think that it really starts from what is your intrinsic motivation for investing. And a lot of people I know that do angel investing do it as almost an ecosystem investment purpose, where it's not truly driven by all the returns. It's maybe if I'm investing, I'm going to get better returns, better companies coming to me in the future. So there's a lot of, gamemanship involved in this.
So I see I have another, maybe Tarek wants to answer as well, but I guess one question from my side following what you're saying is also that if the type of investor changes as the ecosystem matures, and so in other words, that most of the early angel investors that I've worked with across the continent, from the Lagos Angels and the Cairo Angels, all of them did this also, became angel investors also in a way to, let's say, give back to the community. People who they had experience starting or running companies, they were interested in new technology. There was something exciting about, working with young entrepreneurs. But I don't think, making money was the top reason to become involved. In other words, it was also a way to, to support the ecosystem. And I guess that my question would then be that, if, with a more maturing ecosystem, if other people, join the show, join the conversation, if other people are starting to, and then if it's other people, if they have a different mindset, if they indeed are more focused on, making a return. And I don't have an answer there, but just a thought that came up from what you said. Tarek, any thoughts from you in terms of angels versus professional investors or VC fund managers having a different approach about exits?
So I agree to all the previously said reasons behind investing. So it varies from each angel to the other. Of course, for VCs, I agree that it's about managing other people's money. It's all about IRR and multiples at the end. But for angel investors, most of them, but not all, would be giving back to the ecosystem, as you mentioned. However, it's always a double bottom line. So it's always, it's doing well by doing good. So both go line in line, but it varies from each person to the other in terms of prioritizing which is more important. But I think they wouldn't be all philanthropic investments for angels. Some do, but it's not for everyone. Yeah.
Yeah, and just a little bit, I don't think that it would be philanthropic or I think that people still see this as business transactions, and most of the angel community, they are business people. They're very capable of reading balance sheets. That's sort of their comfort zone, right? And I think that it's people who who specifically choose to make investments and not give grants or not give a, this is not about giving a check to your cousin so you can start a company, right? This is with an investor mindset and somewhat of a portfolio approach, and you take it serious. But it's still interesting to see how in a developing ecosystem what the future will look like, also in terms of people that become involved. So I wanted to.
I could chime in here just anecdotally. I know several of my friends that were investing, especially in Nigeria in the early days, and almost everyone thought we were out of our minds, right? The people were saying, I hope that you're not borrowing this money to be investing. It was completely the case. And now with the exits from some of the exits that we've seen, especially with the PaySec exit, it's this validation, this proof positive. And so there's no doubt in my mind that people are coming in that are different than before, because the question before was, Africa is always special. So Africa's different. Technology investments don't work. We're not like, all of this kind of special and uniqueness to Africa, but in the side that it doesn't work, that it's not the same. But I think, from 2015 forward, this has been similar across the world, really, that people are starting to recognize that these ecosystems all around the world can work the same, and digital commerce and digital technologies are really good. So there's two sides, I think, to it, especially when you involve the diaspora. The diaspora is seeing real money being made, and they want to be a part of it. And then some of the wealthy people in country, in Nigeria especially, are now taking it seriously. One of my friends got $1 million offer from Dangote, and then he pulled it back, right? Because he was scared at that time. And that was like in 2013. But now I don't know what he would do, but I'm just saying it's a different flavor of people who are coming into the market.
Okay, very good. So I wanted to.
Sorry, I also want to just.
Of course, go ahead.
Be a bit controversial, but we say just because we are an investment firm doesn't mean that everything is just about IRR and everything is just about returns. Because there are different ways to kind of go and do this. And I think if you are short-term greedy, if you kind of go and really just, if it's purely just about the numbers, I think you are missing the point. To be honest, stay out of venture capital and go into kind of other kind of areas. I mean, we are building an ecosystem. It is about the success stories. It is so. Sure, our investors have given us a mandate to kind of go and make money, but not at any price and at any cost. So the big point is, I think, it's quite an interesting one. We are absolutely not an impact fund, but we have kind of done an impact study on what we have achieved. And actually, we are beating quite a lot of impact funds in the impact that we have kind of made in the ecosystem. And I think it is very, very important to us. And actually, it's also very, very important to our investors. Like, for example, when COVID started, while we were internally, right at the start, kind of said, well, what can we do? How do we prepare? It was actually our investors who in parallel came to us and said, you have to step up. You need to kind of come to the party. You need to help. And we are happy to kind of go and accept short-term a lower return, because we have to kind of go and do the right thing. So I must say, I sometimes, I'm getting sometimes a bit frustrated when venture capital equals vulture capital, when it's all just about IRR. It is important, but it's definitely not the only thing. It's about maybe being long-term greedy. Sure, absolutely, we want to make money. I only make money if I get carried interest, 100%. But there is something about how to do it, and that actually goes broader than just money.
Thank you, Andrea, and of course that's a very valid comment, and I very much like what you're saying in terms of you can invest in different ways. You can be, there's different type of investors, and the right type of investor, thinks about more than the money. And it is a long-term game, right? This is not about, like you say, you can be greedy, but that might bite you in the back so many years later. Very good. Thank you so much. So we have a couple of questions coming in from the audience and the participants. One question is from Sarah Johnson. That is about that's saying that, you know, finding a buyer, an investor to exit on the continent is tricky, or can be tricky. So therefore, are there any networks that you use? Are there any sort of networks similar to angel networks, like deal sharing platforms, that are recommended to help building relationships and improving the chance of finding a buyer? So I guess it's maybe sort of in the VC world, or, you know, how do you engage with each other? How do you, you know, I guess, share each other? Are there deal platforms that you use today?
There are none that I know of from an exit point of view. So, so first of all, I don't necessarily kind of go and look for buyers on the continent. I look for buyers wherever, globally. I think that the big question again comes back to, what is it that I'm selling? What is, and who needs this? And in some cases, international companies want to get into Africa, so it's actually an international company, or, you know, there's so many different reasons to kind of go and look. So I think the first question really is, we call it to build this exit universe. You really kind of go and figure out, if this is what I've got, who would potentially be interested in it, and you kind of go and start, you understand this broader exit universe, the kind of companies that might be interested in. And then again, it's a long-term game. So, I mean, one of my little, if you want to, tricks is, I kind of go and, so I have, for a lot of our portfolio companies, I have a list of the 10, 15 potential companies that are, that could potentially be interested in at some stage. So I kind of go and start connecting with some key decision makers of those companies on LinkedIn.
Absolutely.
Every time that I share something on LinkedIn, they see it. And it doesn't mean anything, but you know what? The point is, over 3, 4, 5 years, they have seen certain news about certain companies, which makes it so much more easy to kind of go and when you finally kind of contact or reach out, or that they actually reach out to you, because it is about visibility. It is, so there is a long-term kind of strategy around it. So the point is, it is actually a very proactive approach that you want to look as if it's reactive. So it's really trying to go and make sure that you build the connection, that you kind of go and get onto the radar of certain companies. And you need to kind of go and also make sure that, for example, the typical M&A companies know about you. Because when they go and get the mandate from a financial institution, find me a company that does ... You need to make sure that when they start searching, that you come up in the top 3 and top 4. And that you then are the most kind of prepared one. So again, I think it's about visibility in the right spaces, but this is a long-term strategy, and it's planned. It doesn't just happen opportunistically. I mean, sure, those opportunistic phone calls, they do happen, and that's absolutely fantastic. But hope is not a strategy. That's something you can't kind of go and just think it will happen. You need to kind of go and work towards it more proactively.
Very good. And so out of curiosity, how many sort of how much work is sort of initiated by you guys, and how much is of sort of inbound? So how many calls do you get from, you know, Europe or the US or other about, we want to talk to you about company XYZ, or we're looking for a company that is an expert on, etc.?
I think of our exits, it was half.
Okay.
In some cases we were approached. In some cases we approached, but of those who approached us, we had them on the radar.
Okay, very good. It sounds very gründlich. So there's another question from Amadou Sissoko, and I guess it's a couple of questions actually. So one is about the structure of the angel fund. Tarek, maybe if you can sort of speak a little about that, and then sort of related to that is that the story that you tell that sort of entrepreneurs and companies evolve over time, right? So the entrepreneur that maybe you invest in today will be a different entrepreneur, a different company when you exit 5 years later or 7 years later, etc. So what does it mean for your selection process? I mean, how do you, because you're not going to exit the same company that you're buying effectively. So how does that work? How do you have an exit in mind when you know that the company you're buying might pivot or change or et cetera? How do you go about that? So I guess it's two questions. I don't know if you want to just take the first one, Tarek, or go into both.
Yeah, absolutely. So let's start by the fund itself, the seed fund. It's a complicated one because it's small and hard to raise, because it's a smaller fund would eventually end up as a big fund if you're not too careful. Because if you're raising for bigger organizations, it's going to end up, not attractive to them, and then it's still too big for LPs that are individuals. So it's not an easy fund to raise. However, if you find the right people and the right balance of LPs, so it could be a complete session for that fund. But just basically speaking, who are going to be the GPs, who are going to be the LPs? What's the geography? What are the industries? Is it going to be sector agnostic? So it's basically depending on different aspects of why you're doing the fund. Accordingly, you structure the fund the right way. But it will follow any other fund structure. Even if it's a big one, you need a regulator and jurisdiction, an auditor, a legal entity, an administrator, people who are going to be managing the fund. How much money is it going to being investing, and to what startups? What's the ticket size? How much is going to be reserved for follow-on funding? So there are several aspects in terms of structuring that fund. But I'm happy to discuss that later on. And in our experience, we're still doing that the first time with other people who have been working with private equity and VC companies before, but with a lot of experience in angel investing with Loai Sharbi and Walid Bakr on board. The second part would be, maybe as Andrea said, you're building, investing in companies that would be, let's say, exit ready or with an exit strategy in mind. But it's a little bit different when investing in the angel space and seed funding, because maybe Andrea's more focused on Series A, so the company already has the right product market fit, and they know they've adjusted everything. But we've done several deals that the founders that have completely pivoted, and that is something that is unpredictable. But at the end of the day, you're investing in the team, and a resilient team would be able to pivot and change once, twice, and three times in order to meet market need and adjusting product market fit. So I think that's the key important thing that we look at.
Okay, very good. I have a question from Awil Osman. Awil, I can unmute you and you can ask the question yourself if you're comfortable with that. Shall we give it a try? I guess I cannot unmute you. We have Ayanda. Are you able to unmute? Let me see. Otherwise, I'll just go ahead and ask the question. If I can pull it up. Hold on a sec. So the question is about, what is the most appropriate way to exit if the startup gets acquired and the deal is not good, but the founders are interested? So, there's a deal on the table, the entrepreneurs say, we'll go for it, and that this is simply not in the best interest of either the company or the founders. It's simply not a good deal. How do you sort of kind of manage that situation?
From my experience, I've been a part of 5 exits, right? And because I've invested so early, I'm just happy that I'm going to get some money wired back to me, right? Because at the end of the day, what I found is what you may think your ownership stake is at the end, it's really just like in a Series A investment, or just the type of money that actually comes back to you is sort of maybe not exactly as you imagined it would be based on your ownership stake. So having a relationship with a founder to make sure that I get some fair recompensation is really the best thing. Cause like trying to determine what deal that they take, if they have the ability to do the entire vote themselves or the majority of the vote, is just, that's just what, to me, that's just what happens. It's from my ownership position previously in angel positions, it has never been the case where I've had an ability to determine the nature of the outcome. So I just have never been worried about that, right? Because I can't control it. So it's like something that is just like extra stress that you would put on yourself that you can't really change.
Yeah, I agree. I mean, if the entrepreneur wants to exit, sure. If the company is mature enough and she gives you long enough warning, you can kind of go and get different management in. You can kind of go and say, you know what, then step down as CEO. We put somebody else in there, and you move more into a different kind of role. And so over the next 18 months, we slowly migrate you to the point that you can actually kind of go and exit. But that's normally not how it happens. I mean, so the unfortunate point is, and that's why, I mean, this is risk capital until the end, until the bitter end. If the entrepreneur doesn't want anymore, and there is an offer to kind of go and do this, and you know what, then most likely it is the time for us to kind of go and exit, and hopefully we go and get some money out. And yes, sometimes we kind of go and look at it and say, well, what could have been, but I guess that's just the journey that we have to kind of go. And I think it's also a big question, why does the entrepreneur want to kind of go and get out? Is it because their life situation has simply changed, they are burnt out, or is it because they know something that you don't know? Or so I think, but again, it's all about the conversation. It's all about understanding it. But we are very much dependent on those entrepreneurs, and we need to kind of go and walk the journey. And hopefully, they're not prepared to kind of go and take a deal that might give them some money, but really kind of go and it's to the total disadvantage of the investors.
Okay, thank you for that. We have a next question from Billy. I think we can unmute Billy, and then that question can be asked. Let's see if we can make this work.
Yep, I'm here. Hi guys, Billy here from Algorithm. Thanks for your contributions so far, really, really insightful. Just wanted to get a sense, because a couple of you mentioned when it comes to exits, it's not just the IPOs, but you might have companies in the West trying to enter an African market, and they might do an acquisition, right? So I wanted to get a sense of what are the key considerations that you need to be thinking about when handling a cross-border exit. What's the impact of, the Forex? What's the impact of legislation, etc.? I mean, I guess really trying to identify what are the biggest risks and, what considerations you need to be thinking about if you're trying to structure or endeavor a cross-border exit.
Well, in South Africa, for example, we definitely had and still have we have Reserve Bank kind of issues and so on. So I mean, if an international investor wants to kind of go and acquire the company, I think then the question is, what do they want to kind of do? Do they want to integrate it into their existing kind of structure? Are they very happy to kind of go and just leave it as a standalone and just get the strategic or commercial benefit out of it? So I think a lot is really trying to understand the construct of such an acquisition, and what does it really mean? Like, what does it mean from a team point of view, and so on. And we've seen all different kinds of things. So I think it is quite good at the moment when you and I think it's very, very important that you as the entrepreneur, you understand what you actually kind of go and want. Do you want to get the money and leave? Do you want to still be around? Can you see a future in a slightly different role within that kind of corporate? So again, I mean, there's so many different things, but I think it's about being conscious around all of this and really kind of go and plan. I think the one thing that is very, very important is you need to have your financials and your corporate governance. Particularly if you want to kind of go and do an international deal, your financials and your corporate governance needs to be absolutely spot on. I mean, again, talking about the Visa acquisition of Fundamo, they flew in 40 lawyers, 40. We rented a full guest house, a significant guest house, and they sat there, and I mean, so there were 40 lawyers sitting against one of ours. I mean, that was kind of it. And they went through each and every document and in the data room, and they looked at every international transaction. They looked for fraud. They looked for all the kind of things. And if you don't have your company records and everything absolutely in order, you would have never passed the diligence, or you would never ever go and get the price that you want to go and get. So I think being prepared around that, I think, is one of the key points. Definitely when it comes to cross-border transactions.
Very good, thank you. Just a quick, I guess, follow-up question from my side. So we can all be very sort of self-congratulatory and look at an ecosystem that is taking shape and it's becoming more mature, but obviously we've had a number of exits that are critically important. But do you feel that the attitude from, I'm talking about potential buyers, do you feel that the attitude from potential buyers from outside the continent is changing? Or are the questions that you're getting today are the exact same questions that you're receiving, so many years ago? Do people better understand the continent, or are people? Is the ecosystem more mature today? Are buyers looking at this differently today than so many years ago?
It depends. It absolutely depends. So there's absolutely, so as the ecosystem matured, sure. Potential acquirers, it really depends on what they want to go and get out of it. It's the same thing as when you kind of go and travel and particularly if you have invested in technology companies, you still kind of go and you travel overseas and you want to kind of go and convince someone that you have a AI company coming from South Africa, and they look at it and saying, really, you think you can be on our level? I mean, you are from Africa and AI, I mean, it just can't work. So there's still a credibility issue. It absolutely is. And you definitely don't get the same valuation as if you were based in Silicon Valley. I mean, it is unfortunately the truth. Those who want to invest in Africa, I think the question is, why? Do they believe they get a bargain? Do they kind of go and see the huge market potential? You find both sides. You really kind of go and find them all. So therefore, I think there is not one answer to all of this. But I think it's very, very important that you understand very, very quickly as the company or as the investor who you are dealing with, because that's how you have to frame your negotiation, and that's what you have to kind of go and do.
Very good. Thank you so much. We have a next question from Lundi.
Hi guys. Thank you so much for the insights that you have shared. Really valuable. So I guess it's a question and a thought, and I would like to hear your guys' thoughts towards it. So the way that I see it is that as an investor, when you are assessing a business, you essentially have to look at two markets. You have to look at the market that the business will be servicing, that you are looking to invest in. And then the second market that you have to look at is the potential market that would acquire that particular business. And by doing so, you kind of already have an idea of the likelihood of that particular business being purchased. And secondly, in building that business, you build it with both those interests in mind. So I don't know if you guys have any thoughts around that.
Yeah, there's my thoughts about the exit landscape and its evolution has been that in the early part of the 2010s and forward, especially the mid part, the startups that were gaining money and the companies that would be the local or regional acquirer universe were largely, already established entrenched players that really believed that the replacement cost of the companies that were being funded was too high, right? I mean, it was lower than the acquisition cost, right? So when you look at the local acquirer universe, largely they still think that way in terms of like whether it be banks or whatever. If you are going to acquire something, why couldn't you just build it yourself? You have the teams, you have all of those things. And whereas on the outside, you have to deal with what Andrea mentioned, which is the bias, where, you know, you have to justify that the numbers are the numbers, right? Like, you know, you start thinking, well, you acquired this company based on these numbers, this growth. So it's the opportunity now has been gaining validity of the African technology ecosystem, but that is also the same issue across the world. It just so happens in other regions, there are larger companies that cannot be ignored. So whether it's in Southeast Asia, India, all those other regions, a lot of the companies are so large that they can't be ignored, similar to how Naspers is in South Africa. But the way that Naspers is really doesn't seem like it's a African company in terms of how it generates its capital, because most of its money was generated not from the African consumer, but from the investment that it had. So it's an interesting conversation right now, because I believe that the exit universe from the local standpoint and the foreign standpoint is going to be really, I guess, solidified by a larger African based technology like giant that just has amazing profits that'll sort of, you know, be the major acquirer of companies that we haven't seen yet, but they're emerging.
Any companies you have in mind? Anyone we should pay special attention to?
You can
give me those tips separately. You know,
yeah. There's some things happening, but it's interesting.
Very good, thanks. I think we might have time for maybe just one more question, depending on. But let's take one more question from Valerie, please. Thanks.
Hi everyone. Thank you so much, panelists, for your insights and for sharing all your knowledge. It's been very interesting. I just wanted to find out a bit more. Andrea, you spoke earlier about having some partial exits, and it would just be nice to get a feel or an understanding of what that looks like for you as a venture capital company operating in Africa.
So partial exits are more difficult. So there's two things. Most acquirers want to buy, they like to buy the whole company. So therefore, if it's only partial, it makes it more difficult. Another big challenge, and I think, to be honest, I think that is a big challenge for angels, is that a lot of financial investors, definitely in the VC space, for example, don't have a mandate for secondaries. So like, for example, my fund, I cannot buy out an angel. I could have made amazing deals if I would have been allowed to do it. I can only put growth capital into a company. So this liquidity event is kind of, so sometimes it just becomes quite difficult. So if I own 12% in a company, who wants 12% in a company? Who is interested in this? As I said, it doesn't give you control. It doesn't do this. So if I can kind of go and sell the whole company, well, that's a different story. But 12%, really. So what we then have to kind of go and do is, so quite often, as part is actually, so for us as investors, quite often the management and the founders buy us out, and we just kind of go and help for them to go and finance this, because they want to take full control over their company. So this is how partial exits sometimes look for us as investors. Or we kind of go and offer it to, if there's a lot of other kind of co-investors and who want to kind of go and up their stakes, but we, for whatever kind of reason, say, well, we can no longer add value, or it's no longer strategically important to us, so we want to kind of go and get out. For entrepreneurs to kind of go and only sell their stake, again, is actually quite difficult, because most of the time they're considered as key individuals. So it actually only really starts working if they are no longer the key individual and have kind of gone step down, and then, yeah, somebody's prepared to kind of go and buy their stake to, yeah, just either up their own, or kind of go and, or the company can potentially kind of go and buy it to kind of go and allocate it to somebody as a replacement. Partial exits, they happen all the time, but I just find them far more complicated than full ones.
Thanks, Andrea. And then, so Tarek also referred to partial exits a little bit earlier. Maybe you want to comment there, Tarek?
Yeah, Andrea, I agree with you that they're complicated, and some funds actually, cannot do that, or have a mandate not to do that. And that's why we're in continuous discussions with VCs on how to make that happen in a way that would actually work out for everyone. So if it's a follow-on fund from other angels, it's much easier. But when it comes to VCs, it's a little bit complicated. So what we have discussed with some VCs, and they found that appealing, is that this comes after the major investment that is going into the company. You can still get secondary shares. Let's say you're buying 30% of the company, then you can top that up with another 5% at a discount on the valuation. So we're selling our shares, we're selling up to 30%. So from 10, 20, 30% discounted at 10, 20, 30%. And sometimes it goes up to 50% of the term sheets that we're putting at a discounted rate. So this would give you more shares at a discounted rate. I know that's not a big amount, but it serves the angels themselves into circulating back this money, getting their capital back, or part of their capital, into other startups. That's how we found some VCs interested in doing so, or other angels on the same round. So it doesn't have to be the lead investor. It could be whoever's co-investing and would be wanting to buy another, let's say, 10% from as secondaries and at a discounted valuation.
Thanks, Tarek, and thanks, Andrea. And I think that's almost like a topic on its own, the technicalities around actually structuring those kind of deals. So looking at the time, I have one last question which I want to sort of ask for all of you to comment on. And the question is very simple. That so the audience today are aspiring investors, but we also have some very sort of seasoned investors already that are participating in this program. So the question there would be, what is your advice to people that are interested in becoming investors, or becoming better investors, or taking their investing to a next level? What is your advice? And then maybe if you can sort of zoom in on the exit part, that would be super. But what is your what would you advise people that want to sort of get started here? And then we'll make it the last question, and I think it's time to wrap up after that.
I think it's important, David, to really understand why the why behind investing, and if you're investing because you have time and you want to get involved in the deals, then angel investing is a cool thing. You need to be involved and have the time for that, and of course have the money. If you don't have the time and you want to just monitor that, see the reports, then invest in a fund. Whether it's an angel fund, a seed fund, or another type of fund, you can pick whatever is more convenient. So this is a starting point, but of course there are a lot of other reasons. So leave the rest to maybe get their insights.
Okay, thank you.
Yeah, on my side, I fully agree. First of all, as an investor, understand, as an angel investor, understand why you are doing it. 100%. So if you are doing this because you're passionate in a certain industry, or you're passionate about entrepreneurship, and you get your return through that passion, that's fantastic. If you are doing it for financial reasons, and for financial reasons only, then I think even more, you need to understand how are you going to go, most likely go and get your money back? Do you believe you're going to go and get dividends? Do you believe you're going to go and get that money back in the next run, when the next investor kind of comes in which case you need to understand that if it is, for example, a VC who comes in next, that they might just not be allowed to do this. So then you also need to understand really how long that journey could potentially be. So therefore, if you're, you need to, so, and again, you need to, so it might be that your money is kind of stuck there for 10 years. And if you are happy and if you're comfortable with that, that's fine. But I think you just need to be consciously aware of those things, because I think that there comes the point where, oh, you need to understand how much control you have over that kind of journey, and how comfortable you are, either with having no control or with the control that you've got, because there's so many different things that can happen, particularly if you go and get in very, very early. So many things can happen with this company, and you need to kind of go and you need to be mindful of your own risk profile.
Exactly.
Very good. Very, very helpful. Thanks. Yes, go ahead, Chinedu.
And I think 100% of what everyone else has said. I think I'm an investment banker. That's how I started my career. And the way I think about exits and investing in the venture capital ecosystem is the principle of underwriting, and essentially taking the steps where you understand your risk, and then also the risk that everyone along the chain is willing to take and why they would take it, right? So if you're looking at the Series A, you're making an angel investment, and you know who the seed investors are, the Series A investors are, and you have an idea of who the potential acquirer universe, all of those people along the chain from your angel investment forward are potential acquirers of your investment stake. So if you essentially understand their motivations, understand yours, understand theirs, and build a relationship with the founders such that they know that you maybe have life events for yourself that you want to get, some liquidity back, that you would understand what would drive all elements of that aspect, or just to track it. From my experience, that is critical, understanding who that you need to talk to so that you can potentially exit if you need to. Ultimately, none of that has ever worked besides just waiting for the exit to appear and to trusting the process of my sort of initial investment. And so that's basically it for me.
Okay, thank you so much. So we've come to the end of this masterclass, of this session on exits. Again, I want to thank you so much for making your time available and joining us today. You've been absolutely great in sharing your wisdom and giving some insights in how what your world looks like, and how you think and go about exits. So on behalf of the participants of this cohort of the African Angel Academy, thank you so much. I can only assume that more questions will come up, so we might come back to you via email with some more questions. I think also that we're going to end this program with some online networking festivities. So I trust you'll get some invites to that as well if you have time to join that.